Kia ora and welcome to Shared Lunch from Sharesies and BusinessDesk. My name is Dan Brownskill. I'm the markets reporter at BusinessDesk. We have a great BusinessDesk special for listeners and viewers, which you can find out about at the end of this episode. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Today's episode is all about earnings season, why it's significant for investors, and what we're seeing this time around amid some pretty serious economic headwinds. We're joined by Stuart Williams, who is Head of Equities at Nikko Asset Management, and Victoria Harris, a portfolio manager at Devon and co-founder of The Curve. Welcome, Stu and Vic. It's great to have you on. Victoria, let's start with you. Can you unpack for us what earnings season actually is?
Yeah, sure. So being a publicly listed company means that you have obligations to produce your financial performance to the public and to investors and shareholders. So this happens twice a year in Australia and New Zealand, with most companies having a financial balance date end of June. So therefore, they've got 2 months after that period to report their results. So usually August is when you get full year results, and then again you get half year results in February for December year end. So right now, really busy time in this.
Okay, so that's why we have all these companies reporting at once, because there's a regulated amount of time you have to report. Okay, interesting. And when they report, what are the basic things they are reporting? What do they have to report?
Yeah, so they have to report their financial performance. So that is their balance sheet, their income statement, their cash flow, all those standard accounting requirements. And these are set in a pretty standardized way. So analysts and investors can compare kind of apples with apples. They know that if they're looking at revenue for two different companies, they're comparing two very similar numbers. But the key things to look for is I like to look at what they kind of say around the numbers. So, what is the commentary that they're saying? How did the year go? So they're reporting on the previous 6 months or previous 12 months. How did that year go? What were their achievements operationally or within the business? Did they make any acquisitions? How are they going? Effectively, how has management run the business? And the other key thing is to look at what are their projections for the future. Now, some companies will release actual figures. So they might say, we're going to achieve $200 million in profit next year, or they'll usually give a range. So they might say 200 million to 300 million next year. Those are companies that have quite good visibility of what the next year looks like. Sometimes they don't hit it, but it is quite useful for us analysts and investors to have a number there. But other companies might just say, look, the outlook looks tough. We can't give any guidance or any kind of, financial guidance. So, but the outlook commentary is key because, markets are forward looking, and that's kind of what we want to look at in terms of, okay, well, what does the next year hold? The previous year's kind of done and dusted. And it's like, what does the future look like for these companies? And a lot of companies don't really know. They are trying to sell their business to investors or try to look good, from an investor standpoint to look attractive. So, but they are the ones that are in the weeds running the business, so they've got the best insight into what the next year will look like for their business.
As a journalist, I've noticed earnings releases are always titled either, record profit, record result, or strong performance despite difficult conditions. Those are kind of like the two headlines you see, and it's always like an upbeat headline. You got to dig into the numbers to work out how good it actually is. I guess my last question on that before we move on to you, Stu, is how important are these earnings? I mean, I think I know the answer, but are they particularly important? Do investors care?
Yes, investors should care, but they are pretty important because it is really the only time of the year that we do get to, a lot of us will actually hear from companies and from management teams about how the business is going. And you want to know if the investment that you've made into whatever company that you've invested in is actually returning what you expected, or the company is performing as you expected. So if if you don't that's why they are very key in terms of the financial metrics that they produce. And when you kind of look at a whole lot of companies at the same time as well, it does give you a really good insight into the economy or a sector. If you're looking at a whole lot of retail companies and their earnings, that'll give you better insight into privately held companies that don't disclose their financial performance, and the industry, the retail industry in general, how that's going, how the consumer's going. So you can actually tell a lot from looking at certain earnings from certain companies.
Okay, that's a perfect transition to go over to you, Stu, and say, before we dive into any specific companies, can you set the scene for us a little bit? What is the economic backdrop / context surrounding earnings season this month? What's going on out there?
Yeah, well, it's clearly pretty challenging out there for the man on the street or the woman on the street, and that translates into companies as well, because ultimately they're the purchaser of the service or the product. So things are tough, and we're doing this. We're having this catch up, right before the OCR announcement as well. So interest rates are moving up, and people are talking about those. And that's equally as relevant for companies as it is for individuals. So that really matters in terms of cash. And to pick up a point that Vic made, like when you're talking about earnings season and whether it matters, I mean, cash in bank at the end of the day is really critical. And so I like to say there's no magic money. So at the end of the day, you've only got the money that you've got, whether it was from your sales as a company or from the position as a wage and salary earner.
In terms of the correlation between the stock market and the economy, obviously listed companies exist within the economy, but how correlated are those two things? If the economy is having a bad time, does that mean the stock market has to have a bad time, or is there a bit of separation between those two things?
There can be separation, to go to the short answer, but I mean, they are somewhat correlated. The real issue New Zealand has, though, is that I guess the share market's not a perfect representation of the economy, and neither is the economy well represented necessarily on the share market. So there are some times that it matters and some stocks that it matters. So retailers that Vic mentioned, that's quite important when you've got to how the consumer's feeling and what money they've got left. But if you're something like I don't know, probably a good example would be something like EBOS, which is just reporting now, then that's a staple product or service that needs to be purchased by a lot of people. So you're not going to not buy or not fill your prescription when you've been to the doctor. You're definitely going to do that, and you're going to do that via one of their chemists.
Mm-hmm. Okay, so some parts are very correlated to economic activity, yes. Some parts less so. What about on like a bigger index, like say in the US, the S&P 500? There's a lot more companies in it. Is that more closely correlated to the US economy than the sort of New Zealand index is to the New Zealand economy?
Yeah. I reckon pretty much every index is not a perfect replication, so they've all got flaws. And so if you look at the New Zealand index, we've got a really heavy weighting to healthcare, which actually includes in the index, the retirement village operators, which by most standards, an international investor wouldn't necessarily think of them as healthcare. So, different in different sectors. So Australia's got a massive banks exposure, and US will have a larger tech exposure than we have, for example.
Mm-hmm. Okay, and talk about share prices for a second. Prior to earnings season, around sort of January, there was quite a bit of a market rally after markets had been weak for quite a bit of time, and I've seen that attributed to the idea that maybe we're sort of at the top of the interest rate peak, maybe things might start to get better from here. Yeah. What is your read on sort of what the market is doing at a macro level, and is it getting it right?
Yeah, the market is just dead keen, champing at the bit to actually rally. And so, people think that the interest rate cycle's peaking, all that sort of thing. But you have to stop and think about things like, inflation is still rampant. And that's one of the main things that, analysts will be checking in the updates that we're getting right now. So, companies, if they're suffering from inflation, can they pass it on? And I think that we'll find that the Reserve Banks in New Zealand still got a couple more bullets to fire, and additionally that the Federal Reserve does as well, because I can't see too many markets where, and particularly in New Zealand, where inflation's under control.
Yeah. Okay. We'll talk more about that in a minute. Before we do, let's ignore the big picture and go back to you, Vic, and talk about what you look at when you first get an earnings result. Can you unpack some of the key financial metrics that they do report? I'm talking revenue, NPAT, EBITDA. What are these things, and which ones do you look at most or first?
Yeah. Well, the key thing is to look at and I've had to learn this over the years. It's all about what they don't say, really. Well, most of it is, and it's because they are wanting to highlight the best parts of their business or the parts that have done well. So if you know a company has 3 divisions and 2 of them, it's really highlighting the growth of those 2 divisions, revenue, earnings, whatever it be, and it's not highlighting the third one. That's the one that I want to be looking at. Okay, well, what happened to that one? And it's just kind of looking at the comparable period, the previous comparable period. So in COVID, a lot of companies had huge impacts on their earnings negatively and their revenue. So then the following year looked really, really good if you just looked at that year in isolation, because the growth rates were, 100, 200, 300%, but you're coming off such a low base. So it's really, really important to look at, kind of what happened in that period that you're comparing that growth to. But growth rates are definitely one kind of metric that I'll look at across revenue, across earnings, across NPAT, EPS, which is earnings per share, as well, is really important. Dividends are also key. A lot of companies cut dividends during COVID to keep the cash in their back pockets, and now some of them are slowly starting to reinstate them or start them again and start paying dividends to shareholders. If a company cuts a dividend, that's not a very good sign. But it's all kind of around that guidance as well, the outlook commentary, because you can, you've got to look at it with the kind of a bit of skepticism, because a lot of companies will kind of talk up their own business. But the commentary around the outlook statement. But if there was one, if you had literally 30 seconds and could look at one key metric from a company, it would be, I would skip right to the end and look at the guidance or the trading update, which because that's going to give you a good idea of kind of what the future holds for the business.
Yeah, Stuart almost looked like you wanted to jump in there. Something to add?
Yeah, I was going to ask Vic if she's under pressure, just what do you look at? And but the answer is, and depending on the company, actually, if it's a pretty stable company, then the guidance is the dividend okay? But if you're going into that, because you're going into reporting season with an idea about what might happen, and if you're worried they're going to disappoint, I just read the last line, the outlook statement, and just go and sharp inhalation of breath. And if it's good, sometimes you can give your colleagues a bit of a scare by saying, "Oh, geez, it's a downgrade." That always gets their attention pretty quickly.
Yeah. That's good. Okay, so if you really have to, skip to the end, see what they're saying about the future, because that's sort of more relevant about where your asset's going to go versus what's happened in the past.
And it's all about what the market is expecting as well. If the market is expecting 20% growth and they deliver 10% growth, you might be sitting there going, oh, awesome, 10% is great. But then you're like, why is the share price down? Because they grew by 10%. So shouldn't that mean the share price is up? But if the market's expecting 20%, then that's actually a downgrade, or it's not as good as what investors had thought. So that's going to be kind of the confusing thing for people that are new to investing or kind of beginner investors but the earnings have gone up, but the share price has gone down. So it's like, yeah. I struggled with that when I first started reporting. It'd be a record result and the share price would fall. And I'm like, how do I write that story to make sense? Really hard to get your head around. Okay, one more question on this before we move on is, as an investor, you're a shareholder, a business owner in the company. At the end of the day, all the business owners get is the profits. And yet businesses and investors both talk about this other metric, EBITDA, which is sort of like a sort of underlying earnings. Why do investors and businesses talk so much about underlying earnings or EBITDA
versus just sort of profit, which is sort of the cold hard cash you get to take home at the end of the day.
Yeah, I guess it kind of comes back to what Stu was saying before about cash and, cash being king and being really important. And EBITDA, even though it's not cash, it is a very good metric to see how operationally the business is doing, how much earnings they're generating just from operating. Because the frustrating thing with accounting and a lot of these financial metrics is that they can be modified or kind of tampered with, and so EBITDA is earnings before interest, tax, depreciation, and amortization. We love jargons in the finance industry, and it is, again, you can still kind of manipulate it. So if you're comparing EBITDA of one firm to EBITDA of another, you really kind of have to look at, is that the most appropriate metric, or is it EBIT, which is just earnings before interest and tax? So you're kind of looking at, it depends what industry the company is in. If they've got really high depreciation and amortization charges, then maybe EBITDA is appropriate. So it's quite dependent on industry, but it is really important to look at multiple different financial metrics to kind of get a whole lay of the land if you've got time, that is.
Yeah, right. Okay. But EBITDA does often reflect sort of the amount of free cash flow the company is producing, that it could turn into profit one day, or if it chose not to reinvest.
Yeah, it's a good metric at quick glance to kind of see operationally how the business is doing, because you're just going, your revenue minus your operating expenses effectively gives you EBITDA.
Right. Okay. Very useful.
There's just a little point to make on that, I think, is that if you're looking at like underlying as well, so like because sometimes there might be, business acquisitions or something like that, and so you're trying to figure out what you will run a model that's got some expectations about future growth, and you may not necessarily know how much a new acquisition was going to make, so you'd be backing that out and thinking about that, and then figuring out how you put it back into your future assumptions as well. So occasionally analysts will spend a lot of time trying to sort of pull the flower apart to figure out what's at the very core.
Okay. Interesting. Stu, when we were talking before the show, you mentioned some sort of less conventional things you look for in earnings season, and perhaps when you're meeting with companies, and you talked about like the business's strategy, even its culture, and then I think most interestingly, the body language of CEOs. Can you talk about some of the stuff you look for that perhaps is not a percentage figure?
Yeah, I mean it's just an experience thing. So actually doing this on virtually is fine, but it actually would be much better face to face, and it's exactly the same with a company. So when you're you're asking, you've got at the point to. So what Vic was saying, where you're going, hey. 2 of the 3 divisions are going really well and nothing's said, and then you ask them about the 3rd division, they literally sometimes they do this. Oh, the 3rd division's really good, and you're just going, oh, I'm not an expert on body language, but I don't think that's that good. And so you look at that, and it's actually when we have group meetings, then you sort of know who amongst your colleagues or even competitors is going to ask those sorts of questions. And then the other thing is you just look at it and you go, well, it's now in particular, it's not just about the money. So it's also about, how they're treating staff, what the wage increases are going to be, so like in the Spark result today, they actually called out a 22% pay gap between the genders. So that's pretty interesting. And so, it's I can guarantee that will be discussed in great detail in the face-to-face meetings.
No, I remember it's so true. It's more about getting in front of management teams, and I remember once there was a company that we had covered for years, and we'd met the CEO multiple times, religiously, kind of 3, probably 4 times a year. And then one time we went to meet him, and he was profusely sweating, fidgety, like just was so not like him. And then literally we were like, that's really weird. And then literally within, I think it was, a couple of weeks, they had a massive downgrade to their numbers and had missed earnings. And it was just like, that's the kind of thing that you get from experiences. The more times that you meet these management teams, you get to know them, and then you get to know when something's stressing them out, or not going to plan, or the opposite. If something's doing really well, they're super relaxed, jovial, really, really carefree. Then that's like, okay, well, business must be going pretty well. So it's a bit of psychology in there as well, definitely.
Okay, that's interesting. So those face-to-face meetings can be quite important, even if there are no new numbers shared.
Yeah.
I'd actually state it. Face-to-face is just so much better. Like you just can't get the nuances, and you can't get the slice, the look sideways at the CFO when someone's just drilling down into a particular area, and that they know the answer. And you're just trying to ask them the right question to get it out, because some people will volunteer the answers. They know what you're trying to get at, and things are going well, then they'll probably just volunteer it. But if things are a bit tough, then they're going to do everything they may do everything they can just to squirm away.
Yeah, I remember the closest I get to these are the analyst calls, which I listen in on. And I remember one particular one. There was a company that wouldn't share their customer growth number, and the analysts kept asking, and eventually the CEO just said, we've decided not to share that number this earnings, this cycle. And I was just watching the share price live, and it just started ticking down as soon as she refused to answer that question. It was a very interesting moment.
That's another thing. If there's some graph or chart or anything that they produce religiously every results or earnings season, and then all of a sudden it's not in there, you can kind of take that as a red flag that they're trying to hide something, or it's not as good as it was last year, or so that's quite handy when you're comparing prior periods.
Yeah. So a retail investor is probably not going to get a face-to-face meeting with the CEO. We might bring them on shared lunch, and they might get to see them through a camera. But what about, is it worth going to an AGM just to sort of meet the management team and see how they look? Is that something that might be worthwhile for a retail investor who wants to kind of replicate that experience a little bit?
Yeah, definitely. You should. It's your money at work, and there's actually nothing more satisfying, probably for your investors as well. Like when you go along to an AGM and you see, a grandparent with maybe their grandchild, that's pretty cool. And you go and try and explain to them really early on what it's all about, and that they own, that they've got every right to be there, and that they own a share, and that they can, talk to the man or the woman who's supposed, or who is the big boss, and that they need to talk to you because that's their opportunity to connect with you and for you to connect with them. But companies are actually doing a pretty good job now of having a wider forum to allow investors to get in contact with them.
And yeah, you can always email them if you have any questions. Most companies have investor relations departments that are created to do that. I remember one AGM. If there is one AGM you want to go to, it's the Restaurant Brands one, because you get free KFC and Pizza Hut. So, well, you used to. I don't know if you do anymore. The share price hasn't done that well, but I remember that used to be a very, very well attended AGM.
I bet. Okay, let's not go chapter and verse, but let's dive into a couple of companies that have reported earnings so that you can kind of get a sense of what these earnings might look like and how they've been received. Stu, I think Fletcher Building is one that is in your portfolio and reported this week and sort of downgraded its earnings. Can you talk us sort of briefly through what happened with Fletcher Building, what was in its earnings, what led to the downgrade?
Yeah, so it's actually... They updated the market before they were supposed to for their actual scheduled time. And it's, Vic will probably hopefully agree, that when something comes out early, you usually have a sense whether it's an upgrade or a downgrade. Like we, at Nikko, we have a pretty good idea about when company board meetings are going to be. So if you're worried about something, you know that the next day you want to be checking what's going on. Anyway, that's a long old story. So they updated the market. They put out some virtually final numbers 2 days before, And that's you look at it, and I saw the result come up, and I said to my colleague, I said, "Hey man, these guys aren't supposed to be reporting for another 2 days." And he just sort of shook his head and started bashing away at the computer. So we were expecting that they were going to have a bit of a tougher time, and it goes back to one of your earlier points about how the economy is going. So it is harder to sell houses at the moment. Costs are up. People are being careful about their money, so that's definitely a contributor. There's been a bunch of other, at this stage, mostly non-cash charges or provisions. So they've got some costs coming for things like the convention centre, so they have to, I guess, deal with that. The slightly odd thing about it is that they are calling out weather, yet we're talking about we were in February, and we're talking about the year or the half year that was ended in December. So that's, it's valid for the guidance, but that's a bit of a challenge in terms of the historic numbers. So the high level would be it's going to be harder to sell some of their properties. There's challenges and costs going up in particular. But I'd say that many in the New Zealand market were probably expecting that they had a harder time coming, just weren't sure of the exact timing.
Yeah, it was quite a weird way that they delivered results in terms of 2 days before doing the update and then the actual result. A lot of people were thinking, oh, is this because they don't want to talk about the downgrade of the trading update? They want to talk about the previous result. I think it was the same time that the Cyclone Gabrielle had happened. So there was, are they trying to hide something by putting it out when there's a lot of news already in the media? And you do get pretty skeptical if companies, put their results out 4 p.m. on a Friday of a long weekend or something, because it's you're not going to get a lot of eyeballs on that result. So you are a bit skeptical when companies change things. Yeah.
Yeah. Okay. Interesting. And that harks back to what you were saying at the start, that what you're looking for most is the outlook. Because when I asked you about the results, none of you said, "Oh, revenue was up X%, down X%." It's straight to the outlook.
Yeah, you are looking for. You are interested in the real weeds of it, and that confirmation points that things are going well. So we'll have a different thesis on a company than Vic will, and so we'll be looking at those particular points that we think that we know a bit more about, or that. You're definitely getting into the weeds of it. So everyone will look at it, and you can see that when you listen to those conference calls, you'll hear that people's questions are coming from a slightly different angle, and that's because they believe a bit more in one part of the business or another.
Yeah. Okay. Another stock I know retail investors will be very interested in is A2 Milk. It was very popular in 2020, 2021. It's sort of fallen on hard times recently. I'm not sure if that's one you own, Stu, but could you unpack the result for us a little bit?
Yeah. I think that was Monday. So they've had a hell of a challenge, really. And, in many respects, the actual performance of the company is really, really good in challenging times. And when I'm talking about challenging times, when they're dealing with milk formula being sold into China via a whole lot of different mechanisms, that's fine. You can sort of get your head around that. But when you're a mum or a family in China, you've had some really, really odd communications to deal with. So like during the COVID times, it was like, oh, if you're thinking about starting a family, don't do it if you've just been vaccinated. And then soon after that happened, oh no, that's fine, don't worry about that. And you're going, it's probably a scary enough time without having that sort of stuff to deal with. And then they're going, okay, get vaccinated or don't get COVID. And so that's led to quite a fall in terms of the appetite for the product, nothing to do with, or birth rates actually, so nothing to do with the actual relevance of the product. The product relevance is actually improving a lot, and so happy about that. But the big, I don't know whether it's macro or demographic or probably social's the sort of social guidance and social norm of what to do starting a family post-COVID, whether you've had COVID or you've been vaccinated, is a real challenge for that company. But other parts of it, they're going, really, really well. They've got new products, new markets, or existing markets are improving. So, generally it's quite good, but it's swimming against a really, really tough tide.
Mm-hmm. Anything to add, Vic? And then I want to talk about PushPay very briefly.
Yeah, I mean, A2 Milk, it's been, it's an interesting one. They did really, really well when you could travel and you could take infant formula up to China, and we had, all this influx of what you call daigous, where they would literally pack suitcases, and then you think about that on even a greater scale, pack containers, and it's a bit of a grey market, but they'd sent it up to China, and that was all cut off completely during COVID. So it's kind of, investors are asking, is that going to come back? And they're putting it together with what Stu was saying about the whole macro thing, and it's kind of it's a pretty difficult business at the moment. But yeah, time will tell.
Okay, all right. Now, PushPay is not reporting earnings, but it's just too interesting to not talk about. So, they're subject to a buyout bid. Sort of, it's over $1 billion. But Stuart, your firm is going to vote against the scheme of arrangement. They're going to vote against the buyout bid. Can you talk us through what's going on there and why you don't want the deal?
Yeah, definitely. It's really, really unusual. It's particularly unusual because we're talking about it in a public forum. So there are things, support or non-support for deals and all the rest of it that go on behind the scenes. But in this case, it's definitely broken cover. So ourselves and a few other investors have put out releases to say that we're not going to support it. So in the instance of, just to be really clear, we've actually already voted. We're not going to change our mind. And it's slightly sobering getting a request from the takeovers panel just saying, you've done this, blah, 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 just confirming a few things. So not even sure I should tell you that, but it certainly does focus your mind. The weird thing about this is that I guess it comes down to a difference of confidence, opinion, outlook. So our view of the company is really positive. We like the management, we like the markets they address, and we're very, very happy to back them for the next 3, 4, 5 years, even longer. And so the essence of the recommendation that the board has made was basically taking away some of the future risk and reducing the price. And that it's just reduced too much. Like, we're happy to stay invested in 10% and 10% and 10%. The valuation range that the independent advisors have come out with is higher than the offer that was recommended by the board, and is actually pretty conservative in our opinion anyway. So it's not compelling. It's not in our best interest. It's not in the best interests of some of the people who will see this video and our investors to accept it. So but the numbers are really, really important. Now, it might be too detailed. If you're interested, I'll tell you. But because the potential acquirer can't vote, then the fact that people are coming out and saying no means that investors have got the chance to knock it back, which would be really cool.
Mm-hmm. It seems like usually when a board recommends a deal, boards represent shareholders. Usually when they recommend a deal, shareholders generally follow their lead. But this is an occasion in which shareholders are saying, we hear you, board, you think this is a good deal. Some of us don't, and you're actually going to vote against it.
Yep, absolutely. And, sometimes boards, because we're partners with boards and companies, so there's lots of conversations that happen where people socialize things that they're thinking about. But in this case, they came out and the scheme of arrangement they recommended it, put the scheme of arrangement in place, and that really forced our hand, or the hand of all the investors. And so it's just we're just dancing to the music that's being played to us. But the main story is that there may be some volatility, but the company is worth more in the future, and hence today as well. So, don't vote in favour of it.
And that's the tricky thing with takeovers is that, companies like that will come out with a really attractive premium of, say, 20% to try and encourage, the smaller shareholders to agree. But yeah, it's kind of when share prices have been a lot higher for this company, and it is been through a really tough period during COVID, a lot of these takeovers, and for other companies as well, can be pretty opportunistic. You've got these big companies coming in saying, they obviously see value in the company, the share price is on its knees, let's make a bid for it. So it can be quite, it's quite good to push back sometimes, because it also sometimes puts a little bee in the bonnet of the company itself to go, you know what, we need to get our A into G to actually not be taken over again. And that can have a really positive effect on the share price as well. So, yeah.
I definitely agree. But I also think that, the people that trust us with their money are going to expect more and more of this. Like they'll want to hear more advocacy on their behalf, and perhaps we need to acknowledge that we need to do more of this in public to take people along on the journey with their money.
Yeah, and purely for balance, I will emphasise again that the board of directors has recommended shareholders vote in favour. So there are options there.
Yeah. Yeah, no, that's good. I'll just remind you that we reckon you shouldn't.
That's good. There's lots of options. The good news is that Sharesies has a voting feature now, so push-pay shareholders will get to make up their own minds.
Cool.
That's actually really important. So it's critical.
Yeah, it's interesting actually talking to people involved in these things. They say sometimes the difficulty is not getting enough people to support the deal, but enough people to actually show up and cast their vote. So it is. They are very keen for everyone to vote one way or another. I think we are coming up towards our time. Should we talk about RBNZ very quickly? You got time for that, Stu?
Yep. Yeah, definitely.
So we are obviously, we haven't had the announcement yet. We're recording this. It's Wednesday, 1 p.m. for listeners. By the time they are hearing it, they will know the result. So we shouldn't make any forecasts that will then make us look silly. but markets are priced sort of for a 50 basis point increase, bringing us to official cash rate of 4.75. Is that what you expect as well, Stu, Vic?
I'm going to let Vic go first. She's going to lay down the ground.
Yeah. I mean, the interesting one with this OCR announcement is the impact that we've had on New Zealand in the last couple of weeks, and so it'll be really interesting to see how they navigate that. Do they go only 0.25, to help alleviate the consumer a bit more with interest rates, or do they kind of stick to the narrative that they've had about being aggressive and curbing inflation? So I am not an economist and can't give you my prediction, but I think I'll play it safe and go with the market consensus of 0.5%.
I think if it's something other than the consensus, then the only thing that we're debating is, the next rate increases are still coming. So it just determines what the next increase will be. So, we've got an inflation issue which is not under control. It might be peaking, but we need to get it back to a more sustainable level because it's devastating for business and ultimately the economy. So if we're surprised either negatively or positively, then there'll just be an adaptation coming at the next rate rise.
And a little bit like earnings reports, the monetary policy statement, which is what the rate decision is contained in, contains a lot of stuff that is not the headline change to interest rates. What other things would you be interested in that report? Will there be some forecasts you're looking at? What else might come out in that announcement?
Yeah, lots of things. So the forward track for rates is important. There's often a special topic included in the monetary policy statement, but the key things about the forecast for unemployment. So, that's actually really interesting. Like if the Reserve Bank was forecasting a lot of unemployment, which is one of the natural balancing items, then that's going to cause quite a bit of trouble for the government. So things like that become really interesting. And then what's happening with immigration. So we need workers in the country. So if they're forecasting that, there's going to be either unemployment or not unemployment and migration, then the core assumptions all around it give you a really good steer about things that you should look out for, and you can actually put back into your company valuation models and thoughts.
Awesome. Okay, that's probably all we have time for. Do you each want to finish with just one key thought or takeaway? If you had one key takeaway from the episode, what would it be? Do you want to go first, Vic?
Yeah, I think if there's one thing that investors should remember. It's that, markets are forward looking, and to look at kind of, if you're looking at a company's result and you don't have a lot of time, the guidance and the outlook commentary is key, and it'll give you a really good indication about the economy as well, if you're looking at a whole lot. So
I've got two really. One, it's good to do this. So that was a bit more fun than I thought it might have been. So that's good. If you're worried about or you're thinking about shares, there's a really, really good reason to invest in shares, and that they are a natural hedge. So, if you like travel, you can buy Air New Zealand shares. If you don't like paying parking charges at Auckland Airport, buy Auckland Airport. Probably everyone's got a mobile phone, so you can effectively hedge some of your costs by owning some shares in those types of names. So shares may look a little bit scary, but they actually have a really great additional function if you own some for yourself.
Thanks so much, everyone, for tuning in, and a big thanks to Victoria and Stuart for joining us. We really appreciate your time and insights. We at Business Desk have a special offer for Sharesies investors. If you use the promo code SharedLunch2023, you'll get $100 off an annual subscription to Business Desk, which is usually $249. The offer only applies to new Business Desk subscribers and can only be used once per subscriber and can't be used with any other discounts. Thanks so much for listening, and enjoy the rest of your week.